Good afternoon. It's Fred Oltarsh from Lieberman Futures, here to discuss advanced option strategies effectively using risk capital. And the gist of the discussion really is to be able to find out what's a good strategy, what's the advantage of using it from a point of view of risk reward and also in terms of value. So included in the discussion will be essential options characteristics, the Greeks, implied volatility and the skew, options valuation. We'll discuss Black-Scholes and other strategies which are sort of arbitrage strategies, butterfly spreads, put-call parity, strangles versus guts. We'll discuss some other specific option strategies which are not arbitrage strategies, and particularly we'll discuss the options pairs strategy. So thanks for joining us today, and I hope this is informative and productive for you. The following analysis includes transactions for educational purposes only and does not include commissions or any extraneous factors like market illiquidity. Assumptions are made about market prices. Futures and commodities trading involves significant risk and is not suitable for every investor. The essential options characteristics you might want to consider, or should have already hopefully, are that calls have deltas which reveal how much the price of the option will change depending upon a 100-point movement in the option, in the market, I'm sorry. And of course, puts have the same feature. They change at a certain rate depending upon a 100-point move in the future. The implied volatility refers to a mathematical percentage for the value of an option. It was made famous by the Black-Scholes model. An option's volatility refers to the amount the price of the option will change based on a 1% move in the implied volatility. Gamma refers to the rate of change of the delta for a 100-point move in the underlying. And the skew, which we will discuss often, refers to the slope of the implied volatility of the options in a series. Options valuation. The value of options can be compared by several methods. They can be compared by the Black-Scholes or similar models, and they can be compared by certain arbitrage indices type of thing, whereby, for example, butterflies can convince you that the price of an option is wrong. Or conversions, put-call parity. Again, it's an arbitrage opportunity. It can convince you that the price of a call is too high or low compared to the put in the futures contract. And strangles versus guts, similar, exactly the same trade except for interest rates. All of these type of arbitrages would be ways of saying, the value of one of those options is wrong. Now, the Black-Scholes model sets up an implied volatility system whereby you can look at the implied volatility and say, this is high compared to something else. But it's not a pure method of arbitrage. Butterfly spreads, conversions and reversals, and strangles versus guts would really be considered pretty much pure arbitrage. Market makers use these methods and others to determine the relative value of an option. The goal is to establish a position by buying and selling options which have an inherent price advantage. Market liquidity is based on market makers providing a service and making small gains for providing liquidity. Here are a number of strategies that we look at. We have bull strategies involving the purchase of outright calls, purchase of call spreads, purchase or sales of ratio spreads, bull fences, or options pairs. On the bear side, we have purchase of outright puts, purchase of put spreads, purchase or sales of ratio spreads, bear fences, and options pairs. The skew refers to the slope of the implied volatility in the options of the series. Markets with a call skew include coffee, sugar, cotton, soybean, corn, and wheat. Those with a put skew include crude oil and the S&P. Here's an example of a put skew. In the S&P, you can see how the implied volatility increases the further you go out of the money. That's a good put skew. S&P has a beautifully, highly pronounced put skew. In the case of the call skew, the S&P has a call skew which gets cheaper and cheaper and cheaper, which is the reverse of the put skew. So you can see, further you get out of the money, the lower the implied volatility is in the calls. For coffee, it is the reverse. The coffee calls have higher and higher implied volatility. As you go further and further out of the money, the implied volatility gets higher and higher. On the other hand, as you get further out of the money on the put side, to a certain point, the implied volatility gets less and less. These skews give us the opportunity to build positions that meet our market bias. And that's what we'll use when designing a position. It's one of the things we'll look at very closely to determine the best way to put on a position. Long fence takes advantage of the skew. In this case, you would be long the calls and short the puts. It's a long strategy, and if the implied volatility was lower on the calls than it is on the puts, you would buy the calls, sell the puts, put on a long strategy, and take advantage of the skew. On the other hand, if you sold the calls and they had a higher volatility than the puts that you bought, you could put on a short fence and take advantage of the implied volatility there. We also look at a very important strategy to us called options pairs. The options pairs strategy uses the implied volatility skew to establish an options positions with a theoretical advantage. It's ideal for hedging or speculating long or short positions in many markets. It initiates positions with good risk-reward parameters. It uses the implied volatility skew of the market to generate a position which meets the goals of our market bias, and it generates a cash flow in a transaction which would normally be expected to have about a 50-50 chance of occurring. So what we do is we initiate a position with the calls and puts as equidistant as possible from the current trading price. At that exact equidistant point, the strategy shows how trading certain spreads versus other spreads gives one a quantifiable advantage. Just as the toss of a coin sets up an equally likely event, heads or tails, the strategy, when the futures market is settled, is the same distance from the call and the put strikes, creates a meaningful comparative relationship. The options pair strategy locates trading opportunities with a similar risk scenario. Not that easy to say, not that easy to spot, but in fact does exist. It locates those scenarios, which, like the cost of a coin, have different sets of payouts. In other words, we put on the strategy, or we find the strategy, and you would expect it, because it's equidistant from where we're trading, to be about a 50-50 proposition. But it isn't. In fact, it has a different payout. So, for example, in the example above, you see a long call spread, buying the 80-83 call spread, and selling the 74-71 put spread. The idea is that it's equidistant between the two strikes, so it's about $77, and we create a small premium for putting on the strategy. Anywhere between $74 and $80, this would break even. If the market goes higher, we're long the options pair and we take advantage. And if it goes against us, we would lose less than what we originally expected to make on the upside. The short options pair is the same. Now, this can be a little bit difficult to understand in a chart form, in a graph form, which I'm showing you now. So I'll show you the chart form, and I think you'll find it more convenient to look at. Here's the S&P. We're trading 1168.90, and we're going to sell a call spread to get short. We're going to sell the 1220, 1260 call spread. We're going to get short by buying the put spread, the 1120, 1080 put spread, which are pretty much equidistant, although it's a little closer to the put spreads, which is good for us because we're going to buy the put spreads. And by buying the put spread, we give up 1110, and by selling the call spread, we take in 1530 for a total intake of 420, which is $1,000. Now, since it's a 40-point spread, it's worth $10,000 in the S&P. So we're generating a $1,000 credit for a $10,000 spread, which is approximately equidistant to where we're trading now. Because of the skew, we are able to generate this kind of spread, this kind of credit, on a spread that you would expect to be about even, because the distances are about even. So we're able to put on a short position. We're able to either short the market or hedge our long stocks, and we're going to get an advantage of about 10% to do it. The options pair strategy is very useful with the S&P. Now here's one with a crude oil, to go short crude oil. Current price 85.09. We're going to buy the 81.78 put spread. We're going to sell the 89.92 call spread. We're going to do it for a credit of 6 ticks. Now 6 ticks on a $3,000 spread really isn't that worthwhile. So, in fact, options pairs on this particular market isn't that effective. If you want to get short, you want to have a buffer zone, it's still a good strategy, but it certainly isn't taking advantage of the opportunities that might be created elsewhere. Now, in coffee, if you want to get long coffee, you're going to buy the 200, 210 call spread. You're going to sell the 175, 165 put spread. We're going to create a credit of 97 points, which is $363.75, which on a $3,750 spread, which is 10 cents in coffee, it's almost 10%. So again, options pair strategy takes advantage of the market and creates that advantage. Going over to cotton, we take a look at the cotton. According to this, we're trading 106.97. That was quite a while ago, as we can see, because cotton keeps going limit up. But if we had put this on then, and I'm not saying I did, I'm just saying this was an example we had looked at. The call spread, you buy the call spread, you buy the 111, 117 call spread, and you sell the 103.97 put spread, giving you a credit of 88 ticks, or $440 for a $3,000 spread. These are inherent pricing advantages that are created by options pairs. Soybeans has a similar advantage of $305 on this example for a $3,000 spread. Again, in soybeans, we're going to buy the call spread, the 126, 132. We're going to sell the put spread, the 112, 106, and we're going to create that advantage. We're going to look at why this makes sense. For pure arbitrage, when you're trading in the pit like I did for a long time, I made a living doing conversions and reversals. That was converting puts and calls into either if I bought a call and sold a future, I would sell a put. And if I sell the call and bought a future, I would buy a put. And that's a conversion and reversal. It has a pure arbitrage relationship. Butterflies, buying one, selling two, buying another. You can do them at a credit. It's a pure arbitrage situation. If you can buy a strangle and sell a guts, or vice versa, those are arbitrage positions. Unfortunately, we can't do arbitrage positions. They don't really exist because we have market makers in the pit who establish the markets in such an effectively tight manner. Arbitrage opportunities are not there. But I think what we do have to look at these days are fences and options pairs. Fences take advantage of inherent skews and the way things are priced. And we can say if it meets our bias already, we can use that as an advantage to match with our position ideas. Option pairs is a limited risk options position. So we can say we're going to risk a certain amount of money to make a certain amount of profit and take advantage of the fact that the market gives us an implied volatility advantage. My goal is to trade on an arbitrage basis as often as possible. Unfortunately, since it doesn't exist, we choose a value strategy. Options pairs is an excellent value strategy, and so is a fence. I hope you found this interesting. My background includes 15 years on the floor as a market maker and 7 years as head of risk management. If you feel that trading option strategies with good value would be beneficial to you, please go to the website at www.liebenman.com and open an account. For questions or comments, feel free to call me, 212-383-9453, or email me at fred.oltarsh@liebenman.com. I hope this has been helpful, and I look forward to speaking to you soon.